Welcome back, investors. Currently, we're on week 4 of my massive short position that I've taken on the Nasdaq. I've been buying puts on the QQQ. If you're not familiar with my short position, you might want to check out this video I posted 3 weeks ago titled, I finally shorted the market, buying puts on the QQQ. And here we have it, guys. I did it. I'm basically the Nostradamus of Wall Street at this point. I accurately predicted that the Nasdaq would go down this week, and sure enough, it was down 0.32%. So let me just take a second and slow clap myself for my obvious genius. Of course, you know I'm being a little sarcastic here because that's not how option premiums work. Simply holding an option contract for a week, there's something called theta decay, and all of my put contracts that I bought have slowly become less valuable over time as the market more or less has just been trading sideways. In addition, the VIX has been going down. Volatility also affects options premiums. So my contracts, once again, have been going down in value. So here's my active trading accounts that I have with Schwab. Once again, at January 1st of last year, I put in $25,000. I think this account peaked at one point at $66,000, and year to date, I am down $39,000 or about 65%. Options contracts are no joke, guys. You can literally lose everything if you're wrong. However, in this video, I'm going to continue to defend my short position on the Nasdaq, and I'm still holding. I don't think I'm wrong. So my cost basis for these 15 put contracts now is about $19,000. Should the Nasdaq over the next 2 or 3 weeks tumble 5 to 10%, I can easily double or triple up my money in a very short period of time. So we're going to keep making these update videos on the weekends. And if my account blows up and goes to zero, thanks for playing. Better luck next time. I will share those losses with you on this channel. Now, quick thing I want to mention is I was holding shares of Aero Environment, that drone company, but I liquidated those shares to continue buying more puts on the QQQ as I'm still confident a bigger drop is coming. Now, what did not trigger a drop in the Nasdaq this week? And that would be the consumer price index numbers for June coming in at a whopping 9.1%. So why, if inflation year over year is being measured at 9.1%, did the market not sell off in response to this news? The estimate was 8.8. We were well above that. And the reason why is because potentially inflation has peaked. When we look at the price of crude oil peaked at $122 a barrel at the beginning of June. And since the beginning of June, the price of oil is down 20%. So when we get the year-over-year comparisons for July, this will be reported in August, we're going to see a lower inflation number than we saw for June. We also have Goldman Sachs Consumer Index. This measures oil in addition to other commodity prices. Once again, peaked on June 8th. It's been going down. Here's Invesco's DB Agriculture Fund. This tracks basically food prices. And food prices peaked in May. This was freaking everyone out because prices were going up so dramatically. However, we can see since May, it's back down 15%. So what this means is that when we get the CPI numbers next month and the month after, it's going to continuously go down. So maybe the next CPI number will be 8, the month after 7, 6, 5. We're going to start seeing progress in getting inflation under control. Perhaps by next spring or next summer, we might finally be back under 2%, and the Fed can start reversing monetary policy and lowering interest rates again. That is what the market basically reacted to this week. We also got our first batch of earnings reports, mostly from bank stocks. JPMorgan Chase's earnings fell by 28% because they're building up their cash reserves in anticipation for an economic slowdown. This is smart for them to do, but JPMorgan's stock price has already sold off pretty dramatically the last 6 months, so even on this news, it only fell 5%. But the bank stocks reporting, it was a mix. Citibank actually beats estimates, and their stock price surged 10% on reports. Citi has always just had this negative reputation after the 2008-2009, so this bank, more than the others, always trades pretty much at a discount. Let's now check in with the S&P 500 Index, and I show this to you in every video because I always want to highlight this purple line. This purple line is the 200-week moving average for the markets, basically representing the average price of the S&P over the last 4 years. It's the last technical barrier that we haven't broken through that potentially trading algorithms or technical traders or large funds are looking at in order as a buy signal to get back into the market. So I'm convinced at some point this year, could be this month, could be next month, could be 3 months from now, the S&P will fall below this line, and I think that is when the market will start finding stability and more or less break out of its down channel and start trading sideways. So let's switch over to tradingview.com, and this is the channel that I've been charting for you every week on my channel. And the S&P, the whole market, has been locked in a downtrend pretty much since the market peaked in December. The upper end of this range is a bit wiggly where exactly you want to draw this line. It's open to interpretation. But the bottom end of this range is really firm with 1, 2, 3, 4, 5 points of contact. That doesn't happen by accident. And when we zoom into the last couple weeks, since I've taken my short position, there's a line of previous supports here for the entire market at a value of 3,900. The market held at this level on May 12th, held again on May 20th. We then blew through it on June 10th, hit the bottom of the range at 3,600. The market rallied, but the market tends to do this. Previous lines of support become new lines of resistance. So as soon as the S&P got back to 3,900, it sold off, rebounded back to on July 7th, got back to 3,900, and then sold off again. And we're currently in another small rebound. So potentially the market on Monday and Tuesday could be green. If we just get back to 3,900, I anticipate another bounce off. What would be a bullish sign is if we completely blew through this. Now, I don't see this happening because when you go down here, you can see what the levels of trade volume is. And over the last 2 or 3 weeks, there's just been a very low amount of trading. I think a lot of people who work on Wall Street decided July 4th weekend they were going to finally take their 2-week summer vacation, and they've just been gone. Wall Street just hasn't been buying and selling at the same levels that they would normally do maybe in spring, fall, or winter. And the stock right now that is holding up the entire market, especially holding up the Nasdaq, is Apple. Apple over the last month is up 14.7%. That's a pretty impressive performance for 1 month for a tech stock when supposedly the economy is heading for a recession. So look at the price movements of the Nasdaq, the QQQ, over the same time period, up only 7.5%. And remember, 13.3% of the Nasdaq is just Apple. And Apple is 2xing, doubling the performance of the entire Nasdaq index. That just shows you how much that Apple is holding up the entire market right now. So here's the heat map for the S&P 500 on Finviz.com. And over the last month, this is the 1-month performance, every sector is green except energy because the price of oil peaked on June 8th, and everyone is pricing in that the global economy is slowing, commodity prices are falling, the Fed and central banks around the world raising interest rates, it's doing the job, it's working. So potentially what traders have been doing is selling out of the energy sector and just going into everything else. But look at Apple. Look at the size of this box. The size of the box is proportional to the market cap valuation relative to the entire S&P. So Apple, one company alone, is bigger than every energy, oil, and gas stock combined. So ExxonMobil, Chevron, ConocoPhillips, Apple is bigger than all of them combined. So if everybody selling out of oil and gas was just buying Apple, that would account for Apple going up 13%. So I think it's actually really worthwhile at this point to look at the technical chart for Apple. And once again, you go down here, very low amounts of trade volume. The stock price more or less has just been drifting up because no large fund has been selling out of Apple. It was down here at a low of 130. You could argue maybe there's a line of support that goes back 2 or 3 years. I've drawn it in here at 135. But there's a really strong line of resistance now at 150. The 150 was a previous level of support back on March 14th. 150 was a line of resistance going back to July of last year. It's a nice round number, so large funds tend to just input 150 as their buy or sell limit orders. So Apple on Friday bumped up against it. It touched 150. And the question now is, when the market opens next week, Monday or Tuesday, is it going to be bullish and is it going to blow through 150? And if it does that, I'm still not concerned because you can see there's a longer downtrend slope that I've drawn in here. So potentially Apple could even get to 156, and I'm still convinced that Apple and the entire market is still in a downtrend. But I think this 150 line is going to hold and sellers are going to step in and the momentum of the stock is just going to switch. It's just going to probably drift back down to maybe 137 or 135, even on low trade volume. But that's not what's going to happen the next 2 weeks because Apple has earnings coming up on July 28th. This is also the day the Fed is going to meet, so this week for the market is going to be crazy. I think the VIX and volatility will spike, helping my option contracts from volatility alone. But if Apple has a bad quarter, and I've mentioned this in previous videos that I ordered a new MacBook Pro from Apple in March, and it didn't get delivered until June. It took 3 months for Apple to manufacture a MacBook Pro with basically upgraded RAM and then get it delivered to me. So I tried to buy it in the Q2, but they couldn't accept payment until Q3. Is that how that works? I don't know, but I think Apple has been having supply chain issues and issues with inflation and rising costs. They're a hardware company that sells a lot of physical goods that require raw materials to manufacture. So we don't have any leaks from the company about if their quarter is going to be good or bad, but I'm literally betting all my money that it's not going to be a good quarter and the stock will respond by selling off. I think the new level of support, if Apple creates a new lower low, is down here at 120. But if we're actually heading for a global recession and not a lot of people this fall are going to be buying the new iPhone, I think eventually Apple could fall to $100 a share. It's possible. Now, I did mention that the Fed is meeting on July 26th and 27th, and the market right now is already trying to price in a full 1 percentage point, a 100-point basis rate increase. And I think at this point, the market is just becoming desensitized to how aggressive the Fed is raising interest rates. In normal times, a 25 basis point rate hike is what you would expect. We then said, well, what about 50? We got to do 50 to be aggressive. Then last month, they did 75, something that hasn't been done since the early 90s. An unprecedented move by the Fed. And here we are 2 months later, and they're already going to one-up themselves by potentially doing a full percentage point. The Bank of Canada actually just did this. And as I've said in previous videos, central banks around the world are raising interest rates, one, to control inflation, but also I think that there is a added benefit that triggering a global recession will really hurt Russia's exports. It'll bankrupt their country and bankrupt their military faster. And Switzerland raised their central bank interest rate for the first time in 15 years. And there's now talk that potentially the Central Bank of Japan could also raise their interest rates. And this is interesting because nobody talks about inflation in Japan because Japan has had almost no economic growth in 30 years as their population peaked, and their population is in serious decline. But Japan is still the world's third largest economy, and in the past I think they've had negative interest rates. They're paying people to borrow money. But potentially, as other currencies are strengthening against the yen in response to other central banks raising rates, Japan is feeling the pressure, currency pressure, to also raise their central bank rates. And if they were to do this, once again, it would impact the global economy because Japan still is the world's third largest economy. Another downward selling pressure that's coming for the market this month is that lots of analysts are going to start downgrading the price targets for stocks. I don't know anyone personally who listens to Morgan Stanley or Schwab when they give an upgraded rating or a downgraded rating, but lots of large funds on Wall Street do follow this. I imagine investors at Morgan Stanley listen to the analysts at Morgan Stanley about price targets and upgrades and downgrades. Often these are lagging indicators. They'll wait until earnings come out, the stock craters, and then they just magically adjust their price target that is more in line or more realistic with the current share price of the stock. Meta or Facebook being a good example that nobody predicted that Meta would fall by 60-70%, but the price target changes come after the fact. Another thing that we should all be watching out for is that Europe is on high alert as Russia has temporarily halted the flow of gas through the Nord Stream pipeline to Germany. And Russia does this. They've done this in the past. For routine maintenance, they will shut down the pipeline. And they always do this because Russia wants something at the time. And this puts economic pressure on Germany to capitulate and give Russia whatever it wants. So supposedly this routine maintenance is supposed to end and the gas should start flowing again on July 21st. But Russia just might say screw it and say the gas is not being turned on. Russia is getting desperate with their war in Ukraine, and they need European leaders to stop supporting Zelensky and the Ukrainian government. If this does happen and gas does not resume flowing to Germany, then the economic capacity, the economic output of the entire European economy will decline dramatically, and this obviously will ripple throughout global markets. This is something that could happen this month. There's also just been a lot of weird stories and news out of China as they're entering year 3 of COVID lockdowns. They are not giving up on this. And apparently there was bank runs in a rural bank in China. So protesters are among thousands of customers who opened accounts at 6 rural banks in Henan and this neighboring province that offered high interest rates. They later found out they could not withdraw their funds after media reports that the head of the bank's parent company was on the run and wanted for financial crimes. I don't really know or understand if, savings deposit accounts in China are FDIC equivalent to insured. This should prevent bank runs from occurring, but there's just a lot of corruption in general in the Chinese financial markets, and their real estate market is really not secure or sound at all. So that's another ticking time bomb that the world is waiting to go off. So with economic uncertainty in Europe and economic uncertainty in Asia, And with the Fed raising interest rates, this is having a dramatic impact on the valuation of the US dollar. The US dollar is gaining strength and gaining value compared against all other global currencies in response to all of this economic uncertainty and rising rates. So companies have been signaling to their investors that they might be surprised by revenue brought in from overseas as currency exchanges devalues their products. Warnings have come from Nike and Microsoft. Let's see if I can explain this to you guys. So currently the exchange rate for US dollars to euros is 0.99. It's basically 1. But even 3 months ago, it was 0.9. So let's use a hypothetical example and say you have a Netflix subscription in Europe and you're paying 10 euros a month. In order to convert that in an earnings report for Netflix in US dollars, you have to convert those euros to US dollars on the spreadsheet. So if it's 10 euros converted to US dollars, it's $11 on an earnings statement. However, if the currency strengthens, the price of Netflix in Europe doesn't change. They can change it, but more than likely they're not going to, just because the currency value changes. So if your Netflix subscription for 10 euros now transfers to 10 US dollars, a rate of 1-to-1, on the earnings statement, you just made one less US dollar. The value of the dollar is stronger, that should be reflected, but when you're trying to project out next quarter's earnings, it's really hard to factor in currency valuation fluctuations. This doesn't really impact the performance of a company because euros are staying in probably Europe in order to fund European operations. But on an earnings call, this is going to blindside a lot of investors and a lot of companies. Yes, $1 doesn't seem like a lot, but when you're talking about tens of millions of customers, paying for all of these subscriptions for Microsoft Office or Adobe Creative Premiere Suite, or you're buying stuff in the iTunes or Apple Store, this is going to really affect a lot of the earnings statements that are going to be coming up the next 2 weeks. And this is with all currencies. When you look at the US dollar compared to Japanese yen or the Chinese yuan or the Korean won, the US dollar has been strengthening, which will, on paper, hurt the revenue being brought in on these earnings statements. So for all those reasons, I'm sticking with my short position, my massive $19,000 cost basis short position. It's going to be an interesting week or two for the markets. Once again, lots of earnings reports, lots of analyst ratings will change, and we've got this Fed board meeting coming up at the end of the month. All right, that's all for this update video. If you found it informative, give me a thumbs up. I greatly appreciate it. If you have any comments or questions or know something I don't, let me know down below. I love hearing from you guys. Till the next video, take care.